This is going to be Chapter 2 of Individual Income Tax. This is talking about the determination of tax. So this slide could be used as kind of a handy reference for the flow of the individual tax calculation. After having completed the recent quiz, you should be fairly familiar with how the forms for the 1040 tax form looks, but this is just, again, just some added exposure to what those forms look like when filled out. We talked about this a little bit in class, but this is to get in your head a little bit the idea that in general, you're going to want to err on the side of including everything as part of your total income. The only really common exception to this assumption is when dealing with the return of basis. And that basically just means that, for instance, let's say you buy something for $500 and then 10 days later you sell it for $600. Well, you only have to pay tax on the $100 increase and not the whole $600 that you got for the sale. These are some of the less common exceptions. I would say the most common of these would be the gain from the sale of your home. Some of the less common types of exclusions serve to illustrate the importance of having or being a competent tax professional. Some of these you would need to be familiar with, or you might just lump them all into income, not knowing any better. These are some of the explicitly stated items that are included as income, but again, it is probably safer to say just include everything and familiarize yourself with whatever the exceptions may be. I think we talked about this a little bit already, but there are some exclusions that are calculated before you set your AGI or adjusted gross income number, and some that you will calculate after. Some deductions happen after you get your AGI. The biggest importance for this distinction is the fact that there are many other calculations within the tax code, some of which we'll look at in this presentation, that use AGI as part of the calculation of other parts of your tax. So these other calculations could change pretty dramatically if you have above-the-line exclusions instead of having below-the-line deductions. This is just a useful slide for referencing the above-the-line exclusions from income. And another reference slide for below-the-line or from AGI deductions. Using the standard deduction makes doing taxes more simple, and for most people it ends up being financially beneficial. However, you will, as a tax professional, usually want to calculate itemized deductions, unless you're just sure that there really aren't any, to be sure that they are less than the standard deduction when doing taxes. Some itemized deductions require that you meet a certain size or amount threshold before they can be actually deducted. Here is a list of the most common deductions that are not subject to any type of size or amount threshold. Now you see the word limited next to these. This means that the deduction themselves may be limited in the amount that you can deduct, but they're not dependent on you having more than a certain dollar amount of, for instance, charitable contributions in order to be able to deduct any of them at all. Again, these just a continued list of some itemized deductions that are not going to be subject to those thresholds. Here are some of the more common deductions that are subject to threshold limits. For these, you cannot deduct them until they reach the threshold limit, and then you can only deduct the amounts that fall above that threshold. Here it's important to notice that in all of these calculations for the threshold limits, AGI is used to calculate those thresholds. So again, depending on whether you had a lot of above-the-line exclusions or below-the-line deductions, where your exclusions and deductions fell with reference to the AGI line, this could end up dramatically altering what your AGI is, and then that in turn can alter the amount of these other deductions that you may qualify for. These numbers for these standard deductions end up changing all the time. Usually they change to some degree every year. So at least at the beginning of a tax season, and as a student, of course, it's helpful just to keep a cheat sheet nearby to remember what these numbers are, the more commonly used numbers. And obviously, if you're doing a bunch of tax returns that require being familiar with these numbers, you will look at your sheet a few times. And then as the tax season rolls on, most of these will be just committed to memory. Although it's nice to have this nearby, just as a practical reason, just because as your experience increases and the years go by, sometimes you may have more than 1 year's standard deductions in your mind, and it's nice to just take a glance at what the current numbers are, just to make sure you are being accurate. Now, there are some times when the standard deduction is not allowed for an individual taxpayer. Some of these exceptions, at least, are illustrated in this slide. The reason for this is basically surrounded. Well, I don't want to say it's only policy. Some of it is a little bit practical, but basically, this is for policy reasons that these exceptions or disallowances come up. The standard deduction, the purpose of it is basically to find kind of an average amount that would qualify as deductions for most people. So when you find that average amount, obviously a lot of people's itemized deductions are going to fall under that number, and then there will be some that are above that number. But for anyone that's right around that number, it ends up just being a lot more convenient to use the standard deduction. And also when checking the accuracy and the veracity of returns, if someone's just using the standard deduction, it's a lot easier to say, okay, that one's correct. So it benefits both the IRS and the individual taxpayer. Now, obviously, if a return is for less than 12 months, then the IRS is not going to want to allow you to have the average that they've kind of figured out is going to be beneficial for a full year period if you're only applying that to, say, a return that counts for 9 months out of the year. So that makes sense. And then also the married filing separately status, you wouldn't necessarily want to allow a standard deduction for a spouse who is filing separately and the other spouse is itemizing, because a lot of the itemized deductions that are counting for the other spouse are deductions that the IRS would say, at least halfway pertain to the spouse that wants the standard deduction. So you're kind of getting a double counting of some of these deductions, where you're using an itemized deduction for the full amount on one side, and then the standard deduction, again, is just supposed to kind of illustrate what the average person would deduct, or the average couple if you're in that filing status. So you don't want to include all of the itemized deductions on one side and allow the standard deduction on the other side as well. And then the non-resident alien status, again, is just more of a policy decision to not encourage that status. This slide here is pretty self-explanatory. It's important to keep in mind, though, that this last bullet point, that each personal exemption can only be claimed once. So, for instance, I claim a personal exemption for a dependent of mine. No one else can claim the personal exemption or a personal exemption for that same person. So this would usually come up in the case of parents that are separated and both trying to claim or being able to claim, I should say, or qualifying, both parents qualifying to claim one child as a dependent and use their personal exemption. Well, that can only be used by one of the two parents. So this is kind of just a broad overview of the requirements to be able to claim a dependency exemption for someone, and the coming slides will go through these in a little bit more detail. These are the Tier 1 requirements from the previous slide, broken out into more detail. The separate return test, and again, I don't know if I explained this in the last slide, but if we look back at this slide, you'll see that their Tier 1 requirements for any dependent would have to meet those. And then there's two types of dependents under the Tier 2 requirements. So for Tier 1, anyone being claimed as a dependent would need to meet these. And the separate return test is probably the part to pay the most attention to, because basically, again, if I claim a dependent, that dependent cannot file a joint return with his or her spouse unless the only purpose behind that joint return is to obtain a refund of tax withheld. And again, this just goes back to kind of double counting or double claiming of a personal exemption, and the IRS obviously doesn't want that to happen. This is the first of the 4 tests to ensure a dependent is considered a qualifying child. And again, like I said, under the Tier 2 guidelines, and remember you have to meet both Tier 1 and Tier 2 criteria, there are 2 options that you could qualify as a dependent, either as a qualifying child or an other qualifying individual. So as a qualifying child, there are 4 tests that you must pass in order to be considered that. And so with respect to how you are related to this person, that would be the first test there. And then this age test is the next step. And as you can see, under that last, or the last big bullet point there, or I should say sub bullet point, a lot of you, or many of you, may still be considered qualifying children on your parents' tax returns as dependents, because you can be a student up to the age of 24 as long as you meet all these other tests. These are parts 3 and 4 of the qualifying child test. The support test here, the slide is a little bit confusing, only because I think it would be more correct to say that a dependent is not providing or does not provide more than half of his or her support. Because obviously, and you all know this as well as anyone, even if your parents are supporting you while you're in college, that doesn't mean that you couldn't go out and support yourself and provide more than half of your own support or all of it. And just because you could do that theoretically doesn't mean you are, okay? So the real criteria here is that you are in fact not, or the dependent is not providing more than half of his or her support, and not that they are not able to. So again, you don't have to be a qualifying child to be claimed as a dependent. You can be claimed as a dependent under this other tier, or other part of the Tier 2 requirement, which is the other qualifying individual. This slide shows the first of 3 tests that you must pass in order to be considered as an other qualifying individual. And I would say a special note here is that once you establish this other qualifying individual relationship, in other words, once you pass this test, if it is established because of a marriage, okay, the relationship part can stay in place even if the marriage that caused the relationship ends. Okay, so let's say the marriage is terminated. So for instance, let's say I was housing my sister-in-law and claiming her as an other qualifying individual. So this is the little sister of my wife. Okay, if I then got a divorce, I could, and the daughter, or I'm sorry, the sister, or what used to be my sister-in-law, if she still lived with me and I could still claim her based on the other parts of this test, then the fact that the marriage was no longer existent that created the sister-in-law relationship in the first place, that wouldn't matter. Okay, so basically, once you qualify as a relative under this test, you are always considered a relative under this test. Here are parts 2 and 3 of the test for other qualifying individuals. Again, not terribly difficult to calculate here based on these rules. For the tiebreaker slide here, and it's probably pretty self-explanatory here, but basically, as you might expect, these tiebreaker rules that are listed here, they usually come up because of some dissolved marriage where both exes want to claim the same dependency exemption. And of course, as we said before, the fact that one person claims an exemption makes it not possible for the other person to claim. So multiple support agreements will come up as basically a way of formalizing that someone is going to receive support from more than one person here. And this multiple support declaration, which is an actual form, which you'll see in the next slide, this basically serves to say who is going to be designated, or can say who's going to be designated as the recipient of the exemption because of these varying support levels. And anything that's set out in this declaration, this multiple support declaration, would then trump anything that was in that previous slide about tie-breaking rules. So a person could not fill out one of these multiple support agreements and then go ahead and try to fight against that agreement using the tiebreaker rules that are established in the previous slide. That would not work out for them, because once you agree to the terms in this multiple support declaration, that becomes the binding tiebreaker, so to speak, or decider of who's going to receive what. Again, this is just an illustration of what that form looks like. I'd be very surprised if any of you ever actually see one of these forms. They're not all that common, but they do exist. You can guess how often, based on this slide, this actually happens. But what usually happens is the custodial parent, or the parent who is, has custody of the child is living with them, generally is awarded the personal or the dependency exemption. However, a parent, the custodial parent, does not have to take that, and I have seen instances where a custodial parent will not take the exemption. In other words, there are sometimes, for instance, when parents will switch off and say, okay, I know I have custody of the kids, but this year I'll take the exemption, next year you can take it, etc. So it is up to the parents if they want to agree to some other system, basically. Okay, so this is just a nice reference chart of tax credits that may be refundable. And what this basically means is, you can take these tax credits, reduce your tax owed or tax liability to not only zero, where you don't owe any taxes, but also reduce it below zero, where the IRS actually has to give you back all of the money that you paid in this year, plus however far in the negative you went for tax liability. So that anything on this chart, if you have a low enough tax liability already, and one of these refundable tax credits applies and pushes you into the negative in tax liability, you will get or be able to qualify for a refund of that amount. And so obviously, pretty self-explanatory then what non-refundable credits are. And these would just be credits that allow you to reduce your tax liability to zero, but not below zero. Okay, so this would, if this is the only type of credit that you had, you could end up not owing any tax and getting all the money you paid in back, but you couldn't get anything above and beyond that. This credit is one of the reasons that there is a distinction between claiming a qualifying child dependent versus claiming a qualifying individual as a dependent. So basically, as the Tier 2 portion of the dependency test, if you're qualifying under the qualifying child test, then you can claim this child credit. If you are not and you're using the other qualifying individual, then this does not apply to you. So some people do ask, why do we have this distinction between dependents? And this is where that comes up. Again, kind of for policy reasons, you want to encourage the parents of the child to be the ones raising the child. Again, whether or not that is a good policy is up for debate, but that is kind of the encouragement that comes from this particular credit. These next two slides are just a flow chart that you can walk through that will, might be a handy reference just as you're getting used to individual taxation and looking at the various tax filing statuses. So, whether that be married filing separately, married filing jointly, single, head of household. Let's see, what did I not mention there? Oh, surviving spouse. These two slides of flowcharts are a pretty simple way of just going through that and not having to think too much about how to determine those criteria. Here are the criteria that you need in order to be able to claim that you're a surviving spouse. And again, what that does for you, as you see here at the bottom of the criteria in year one, is that you can still file as married filing jointly. Important to note from this slide is that if someone is being claimed as a dependent, but they still make enough money to have to file their own return based on these thresholds, they cannot claim a personal exemption on their own tax return that they file. And the standard deduction that they're able to use, as you can see at the bottom of the slide, is much less than it would be for a normal individual. Unearned income in this scenario, when we talk about the kiddie tax, generally refers to investments that parents have made in a child's name. And the purpose of this is to keep parents from investing their own money, putting that in a child's name, and allowing that money to be taxed at a lower rate because the child makes less money. So in order to avoid that scenario, the IRS has this policy of taxing at the parent's marginal rate. Okay. However, there are some situations where this ends up hurting let's say a student that qualifies as a dependent under their parent, but has made smart investing decisions. Sometimes they end up getting burned by this type of rule because what this rule implicitly kind of states is that, well, if you're a kid and dependent or whatever, and you have this much money and you're investing and it's making money, it's probably your parents doing it. Okay, so obviously, if that's not the case, you could end up being hurt by this policy decision. This is an important concept, the idea of capital gains. classification of whether those capital gains are long-term or short-term capital gains. Actually, during my schooling, I had a whole class that basically the only thing you did in the whole class was determining whether a gain was long-term capital gain, long-term ordinary gain, short-term ordinary gain, short-term capital gain, capital loss, etc. And that was basically the entire class was just determining that. So obviously, this can be a lot more complicated of a topic than we're really going to get into in this class, but this is something that we'll come back to a lot and at least kind of go into and discuss a little bit. And the reason behind that, as you'll see in these next couple of slides, is basically capital gains and losses can end up being taxed at a much lower tax rate, as you can see from this slide. And in fact, if your normal taxpayer bracket is the 10 or 15% bracket, your capital gains tax is 0%. Okay, so obviously that is a significant savings. And all the way up to, if you're in the highest tax bracket, then only 20%, your capital gains are only taxed at 20%. Okay, so I think I talked about this a little bit in class, but if you remember back to the scrutiny Mitt Romney was getting for his, overall tax rate on all of his money, most of that was accomplished through classifying his income in a way that took advantage of these capital gains rates versus just using a normal taxpayer bracket. But the policy reason behind these is basically that capital gains are usually investment income. So this is to encourage people, instead of just sitting on their money, to go out and invest it, even though that might be a little bit more risky, because if you do that, you will then qualify for these lower tax rates. These are just some tax planning considerations that you may run into if you're a tax professional of any kind. Obviously, there's a lot more to tax planning than what you see in these four kind of bubbles here. But from what we've gone over so far, this is kind of a good basic overview of some of the things, just in the brief amount of information we've talked about, that you could go over and maybe provide some knowledge about. These are the thresholds based on filing status when you have to file. This slide and this next slide that we look at, excuse me, usually a good idea to file even if you do not meet these thresholds, especially if you've already started filing income tax. So let's say you've had to file a return for a few years, then you go back full-time student and you don't make any income, you're just living off loans or whatever, grants, then it's probably smart to go ahead and file even if you don't have to, just because it ends up kind of being more of a hassle than it's worth to have a year that you don't file at all. The due dates pretty much, for individuals anyway, stay the same all the time. If you look at that third bullet point, obviously sometimes if it falls on a weekend or national holiday for any of these due dates, then it goes to the next first business day following. These are the various types of individual returns, the 1040 being the most common, or at least the most common that a tax pro would look at, although these other 1040 types of forms do exist as well. And finally, these are various reports that are filed with the IRS and with your taxes that kind of serve to substantiate the information that you provide in your tax return.